Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Dominic Rinaldi.
Welcome back to M&A Unplugged. I'm your host, Dominic Rinaldi. We have a great episode coming your way today. I'm being joined by Doug Adams again. Doug is an expert in SBA acquisition loans, and today we break down the anatomy of a $3 million deal that qualifies for an SBA loan. We also take it a step further by comparing a typical $3 million deal versus the same deal with the benefits of the CARES Act. Doug and I go into detail about the costs associated with this type of deal, the annual debt structure, and what is left over after debt service for the new owner in the way of a salary or distributions. And if you're an owner of a business, they can provide you with some great intel so you can better understand the assumptions that banks and buyers make will only help you be more knowledgeable when the day arrives for you to exit your own business. I really enjoyed digging into this topic with Doug. There's a lot of great information here to help you be better prepared for your own transaction. And if you would like a hard copy of this SBA loan comparison, you can download it on our website at 𝐾2advisor.com. It's K, the number 2, ADVISER.com, and it'll be under the resources tab. Being prepared is critical to ensuring that you maximize returns and minimize risks. Thank you for being here and hope you enjoyed today's show. Hey, Doug, welcome back to the show.
Thank you. Happy to be here.
Yeah, thanks so much for carving out time. Your episodes have really done so well, really has highlighted for us the appetite that people have for understanding financing and what goes into it. And I'm excited to get into today's topic, which is we're going to actually give people an example of a $3 million deal and how that deal would get financed and the components of it. And we're going to throw a little twist in there. We're going to do a comparison of an SBA loan with the benefits of the latest CARES Act compared to the same sort of deal without the benefits of a CARES Act. And I'm excited to go through that. And on the surface, when you and I did this, it didn't seem like a big deal, but when you get to the bottom line over the course of a 10-year loan, it's a big deal. So
yeah, it adds up. It's a nice thing.
It really does add up. So, but before we dive in there, let's talk about the current market. I mean, we talked about this last year at the end of the year in an episode that you and I did where we had anticipated businesses were going to be coming to market, but with softer financials, companies that had been impacted by COVID, and then they were going to want to get to the market this year. And sure enough, we're seeing that, right? We're seeing that companies lost traction last year, but many are gaining that traction back. And we had been telling people banks would still lend as long as you showed that you've got a trend that's coming back to pre-pandemic levels. And you and I and our firm are dealing with that every day, right? I mean, we're seeing so many companies with financials that have been significantly impacted, but they're showing some recovery. And the bank's true to their word of looking at these deals and financing them.
Yeah, they are. And it's interesting because as we've seen, there are plenty or a number of businesses that are still thriving and have thrived throughout the pandemic and depending on the industry and their business model. But as you said, there are numerous ones that have suffered, especially during the lockdown period from last March through May or June. And so as the banks analyze these businesses and go into the cash flow, they're all about having to prove up the debt coverage for the last year, especially the last taxable year. And if there is such a downward amount of revenue and cash flow for 3, 4, 5 months of the year, that's going to make that really tough. The banks have proven up that they will look past that if, as you said, the trends are back to where the revenue was pre-pandemic, or at least enough to establish enough cash flow to cover the debt. And when we talk about the trend and looking at a trend, it can't really just be a month or two. It's got to be 4, 5, 6 months so that you can readily see that it's really back on track. But that shows the flexibility, and the banks are willing to take that into account and go ahead and move forward with the deals. So it's worked out all right so far.
Yeah, I mean, so look, that's great news for buyers who need to get access to lending in order to buy a business, and it's great news for sellers so that they can walk away with a good majority of the transaction in cash at the closing table. But that doesn't mean that there's not still some risks and that the deal structures might be changing. And you and I had talked about this. You know, buyers are going to be more cautious. They're going to have to do more diligence. They're going to have to really be comfortable that the business is coming back. And the deal structure might change in the sense that, you know, if you've got a $3 million deal pre-pandemic, the seller might have walked away with 90% of that cash at closing. But now maybe there's, you know, an earnout component that's layered in there to make sure that the business really does rebound, and that this isn't just a short blip on the radar. And we know that the SBA will deal with that, deal structure as long as the earnout can only go down and not up.
Yeah, the earnout, quote unquote, is an interesting thing. And we've talked about this many times. And the one thing that gets the banks a little more comfortable anyway, besides an earnout per se, is a seller note. And so you've got the 10% down of the usual structure, and then maybe a 10% seller note. And that's maybe 90% of the deal structure that we're seeing. The earnouts, and if you want to get into that a little bit, or the negative earnout within the auspices of a seller note to accomplish some triggers that will allow you to pay less to the seller under the terms of the seller note. So it's a negative possibility in terms of payment to the seller if the triggers aren't met. Can't be a more than the purchase price allows for in a regular earnout situation. Yeah. But one of the other things, just real quick before I forget, that the banks are looking at in this post or existing COVID environment is, in addition to the trying to understand the trends, they're going to ask for the monthly P&Ls for 2020 and going into 2021, and probably the comparative monthly P&Ls for 2019, so that they can assess, you know, especially seasonal businesses, is this really where it's back to where it needs to be? So I would just point that out there.
Well, and I think it's a good point because business owners need to understand that they can't just produce annual and quarterly financials anymore. It's going to be imperative that they close out every month and that they produce monthly statements that are accurate, which means you've got to get the books reconciled and months closed, which is, you know, normal in any business. And a lot of folks don't do that, but that will be a requirement going forward. So I think that's a great point.
Yeah, really important.
All right, well, good. So, I mean, the good news is, to put a cap on this discussion, is banks have the appetite to lend. There's plenty of buyers in the marketplace. If you've got a business that's rebounding, there's a good chance we can get a loan. It may take some, you know, different sort of deal structures, but you know, it's not like lending is shut down. There's
no,
you want to sell,
not.
you want to buy.
And I would also mention one other thing that we haven't really talked about in terms of these CARES Act benefits, and partially because I'm not sure it makes a ton of difference, or at least the bankers are not saying it does, but the government, the SBA guarantees the banks a portion of their exposure on these deals. That's one of the reasons they do absorb all this goodwill, and it's not about collateral, it's about cash flow. And historically, that percentage for these acquisition deals is 75%. So the bank's getting a government guarantee for 75% of their exposure. Yeah. The CARES Act has raised that up to 90%. Now, you know, you say to yourself, well, gosh, they got a 90% guarantee, they should just lend every single deal. Yeah. But banks, being the conservative bunch that they are they know it's there, but it's not incredibly changing their approach.
Yeah, and if they do bad loans, they're going to get audited and they could lose their preferred status, right? And so they can't just because there's a 90% guarantee, they can't just go out and do bad loans, right? So they still have a fiduciary to the SBA to do quality loans.
Right. You would hope that encourages them at least a little bit more to do a deal that they might be on the fence about, but we don't know that.
Yeah. Well, I don't think we would have the CARES Act 2 and some of the programs that are out there that we're going to talk about here if the government didn't want to see lending happen, right? But banks are still not going to be, they're not going to get too far out on a limb. They have to see some good fundamentals. So
absolutely. Yeah.
All right, great. So let's dive into this example that I referenced in the opening here, where we're going to lay out a typical $3 million deal. And when I say $3 million deal, $3 million of purchase price. And we're going to do a side-by-side comparison of what that deal would look like before the CARES Act benefits, and then now with the CARES Act benefits. And again, those benefits are going to run out at the end of September. So acquiring a business before then is imperative if you're going to go the SBA route. And again, the SBA works if you're going to acquire a business and the loan amount is going to be $5 million or less. There could be some scenarios where you could go higher than that, but generally speaking, it's $5 million or less. And let me tell everybody that's listening today that this comparison is going to be up on our website, and you can download it from our website at K2 Advisor. That's K, the number 2, ADVISER, and it'll be in the resources tab. So you can get to that tab and download this side-by-side comparison and see exactly what Doug and I are talking about. So Doug, for purposes of the discussion, we've looked at a $3 million deal. We've assumed that $3 million deal had a cash flow, an adjusted EBITDA of about $750,000, a seller, or otherwise referred to as seller's discretionary earnings. So we put a 4 multiple on this deal. It could be a 3.5, it could be a 4.5, it could be any multiple, but we took a pretty middle of the road example here. $3 million purchase price, $750,000 of adjusted EBITDA. And then we'll go through with the other assumptions and show you exactly what this deal would look like. So Doug, why don't you take over from there, and why don't we talk about what this deal would look like before the CARES Act, and then with the CARES Act changes, what that means to a buyer.
Sure. Okay. So as you said, it's a $3 million loan, a $3 million purchase price example. And in the SBA world, you've got to meet the criteria. There are certain rules and requirements, and one of them being that the buyer needs to put into the deal in equity or down payment 10% of the project cost. The project cost is historically defined as the purchase price, the bank's closing costs, and the SBA fee. So without the CARES Act benefits, you figure out what the SBA fee is dependent upon the loan amount, and you put it into an SBA calculator, and there's a way to get at that dollar amount but it's sort of strange, and so the easiest way is just to put it in the calculator. It's about 2.25% up to 3.5% times the loan amount, depending on how high the loan is. So in this case here, we know that the SBA fee is $66,000. The estimated bank closing costs are $10,000. Now this
and Doug, so can we stop just for 1 second? Why does the SBA charge a fee to begin with? What's the rationale behind that SBA fee? Because $66,000 plus the SBA closing costs of $10,000, that's a lot of money. I mean, $76,000 on a $3 million purchase price. What are those fees intended to cover?
So the 10 is the bank's closing costs. That's not the SBA. That goes to title searches and their filing fees and attorney's fees and valuations and all the things that the bank does to close a deal. The 66 is the SBA fee, and the SBA fee really is the money, the revenue to run the SBA organization. So they get funding from the government, but they also have the contingent liabilities for every single deal that is booked. So if, God forbid, there's a deal that goes bad, they're going to have to pay these monies out and get the bank whole to the tune of 75% or 90% in today's world. They've got staffs, they've got budgets, they've got all these things to run this organization. So that's the price you pay to get that guaranteed benefit, which translates to all the benefits of the SBA deals, which are longer term deals, minimum down payments, low interest rates, no prepayment penalty, not being about collateral, absorbing all the goodwill. So all of these things are designed to enhance and encourage the lending. You've got a price to pay for it, and that is the SBA fee.
Yeah, and look, and you highlight all of the tremendous benefits of the SBA program, because if you were to go for a conventional loan, I mean, one, the interest rates could easily be double what an SBA loan is, and the payback period is typically half, 5 years, sometimes even 3 years. So, and the down payment requirements, the equity injection from a buyer could be much higher. So it's a lot of money, but you do get a lot of benefit at the end of the day in the terms of lower rates and longer amortizations.
Right. So, in our example, you've got the $3 million purchase price, the SBA fee at $66,000, the estimated closing cost at $10,000, gives you a project cost of $3,076,000. So then, as the buyer comes in, the minimum equity injection, and there are some alternatives, but you go down a rabbit hole when you talk about these various different things. But we'll keep it simple. So 10% of that is the required buyer's injection, or $307,600. Typically, as we talked about when we opened, that we're in our example here, and the majority of the deals will have a seller note involved. So we're making the assumption that there's a seller note for 10% of the purchase price as well. So in this case, in the $3 million purchase price, the seller note is $300,000.
And we see that, and Doug, just to stop there on the seller note, we see that in almost every single deal, at least 10%. And the reasons behind that are, one, the banks really like to see that the seller has some ongoing involvement and skin in the game and interest in making sure the buyer is successful. And buyers like it because they want the same thing. They want to know that the seller has some ongoing interest in making sure that they're successful. So it's pretty rare, if ever, that we don't see some form of a seller note.
Yeah, and I will also add that when you have a structure like this, the bank is then lending 80% of the purchase price instead of 90% of the purchase price.
Right.
And it also helps with something we haven't talked about much, and that is the valuation that is done during the closing process of every SBA loan. And the rules are that the bank is not supposed to lend more than the valuation amount. So if that loan is 80% of the purchase price, then the chances are you're going to meet that criteria much more easily.
Yeah, yeah.
So if you subtract the equity injection and the seller's note, that leaves the bank loan in our example here, $2,468,400. For the business only, since we're not talking about a transaction with real estate, you're going to get a 10-year term, 120 months. The rate, depending on the size and the strength of the deal, will be usually between 5.25% to 6%. At this purchase price, this loan amount, we're making the assumption that it's 5.5%.
And the general rule of thumb here is that you're looking at prime plus 2.25%, 2.5%, right?
Or up to 2 3/4, yes.
Up to 2 3/4, yeah.
Yes.
And
so for a $3 million deal, 5.5 is a pretty reasonable rate.
Mm-hmm.
I think that would be the expectation. So with those variables, then your monthly payment is $26,789 or $321,464 a year. To continue on with figuring out what the overall debt service is for the buyer, then we've got the seller note. And again, we have to make assumptions. Here, we're making an assumption that the seller note is a 5-year term, 60 months. The rate is 5%. And that's really, there's no rule other than it has to be reasonable. It's a negotiated rate between the parties. So at those variables, it comes up with a monthly payment of $5,661 or $67,936 a year. The other component that we're adding into the debt structure here, and this is again an assumption, and it really depends on the nature of a given business, is a line of credit. Most of the banks, not every bank has the ability to do lines of credit or express lines of credit, the SBA express lines of credit, but most of them do. And so they're typically usually ready and willing to add a line of credit to the extent that a particular business needs one, because they're wanting to make sure that there's enough working capital in the structure. And so they often will do this. It'll add to the SBA exposure. And the CARES Act has raised up the highest amount of the line of credit until September up to $1 million, in which case, after which it'll drop back down to $500,000. So in this case, we're assuming a $100,000 line of credit. Really, it depends on the business's average accounts receivables and things like that. So put a $100,000 line of credit in, the bank will assume that it is full, for their conservative analysis purposes, assume that it's fully borrowed, and how much interest, since it's interest only typically for the first 3 years, what that effect is on the debt service. So here, $100,000 at 5.5% is $5,500 in interest per year. So if you add up the SBA loan payments, the seller note payments, and that line of credit interest payments for the year, you're getting $394,900. That's really your debt load. That's your debt service per year on the transaction.
Yeah.
So,
hey, Doug, before we get to the next step, I just want to make a comment about lines of credit. You know, most of the transactions that we see in the sub $5 million range, typically they're asset transactions, and the sellers are keeping their balance sheet, meaning they're keeping their accounts receivables, their accounts payable, and they're curing all the debt at time of closing. And so the buyer is typically walking in to a clean balance sheet, but that means they need money to keep paying payroll and other expenses until they start to get the accounts receivables coming in after the closing date. And so working lines of capital are so important, and the program adding the flexibility to up to $1 million of working capital is tremendous. And I caution all buyers that if you are doing an asset transaction and taking over a clean balance sheet, either you need to have a lot of your own equity available, or you need to avail yourself of these lines of credit, because the last thing you want to do is not be able to meet your obligations until you start getting the cash flow coming in after the closing of the business.
totally agree.
All right, so you left off with total debt service payments of being $394,900 in this example, against a business that typically is bringing in $750,000 of cash flow.
Right. So in our example, we use the 750 for each year. Rarely is it exactly that, but so then the banks will, in their assessment and their analysis, they will pull out what they perceive as the household needs for the buyer. This is a calculation they will make depending upon the buyer's debt, personal debt, mortgage payments, home equity line, car payments, credit card debt, dependents in the household. They'll come up with their formula that will determine how much they want to pull out, or how much the buyer feels that he needs to pull out in a salary draw. So in our assumption here, we're using $100,000 as an assumed buyer's draw. So you take that off of the available cash flow, and this is absent outside continuing income that a buyer might have, and that can change the equation. But for our purposes, we'll keep it simple. So that will leave you $650,000 for the cash flow available for debt service coverage.
And I just want to be very clear here. This is just a mathematical assumption that the bank is making. This is not money that's being drawn down. You're not being forced to take 100 out, but it's just for purposes of coming up with debt service coverage. you could wind up taking 75 or 150, doesn't matter, but this is a mathematical assumption the bank needs to make in order to know that the deal covers their debt service.
Yeah, and when the bank is looking at a real deal, they're going to have that buyer's personal financial statement, his credit report, so they're going to be able to understand what his obligations are and adjust that accordingly. So we're just making the assumptions here.
Right.
So then you'll compare that 650 with the debt service of 394, and you get a coverage of a 1.65. Healthy coverage. That's a strong deal. That's sufficient cash flow. That deal, all other things being good or equal, will get approved by the bank.
And just bring people through the calculation. How did you get to 165, and what is the typical coverage that most banks are looking for?
So the 165 is purely the 394,900 debt service divided into the 650,000 available cash flow. So it's a simple calculation. You just divide the 394 into the 650 and you get the 1.65. Typical, the minimum coverage ratio that the SBA requires for its banks is a pretty low 1.15 coverage. However, the banks still have to lend according to their own policies and procedures, and certainly as you get up in dollar amounts, this is more true, that the banks will want something north of a 1.2 or even a 1.25 in coverage ratios. So we have had deals that have gotten done when you have a 1.17 coverage, but those are going to be the smaller deals. If you take a typical $3 million deal to a bank, chances are they're not going to get real comfortable if the coverage is only a 1.17. So I would say that you're safe at a 1.2 or higher, provided again that all other aspects of the transaction are adequate or sufficient. But most of the banks want something a little bit higher than that.
Yeah, and look, the thing that I would highlight here to buyers who are listening, prospective buyers that are listening into this episode, whether you own a business and looking to grow through acquisition or you're looking to make your first acquisition, whenever you can acquire a business that has historically about 750,000 of adjusted EBITDA, and to acquire that business, you only need to take 300,000 of your own capital, and it's going to cost you about $400,000 to over 10 years, $400,000 a year over 10 years to get that 750. You've given yourself a $350,000 cushion. So the business can even decline a bit, and you're going to have plenty of cushion here to make the debt service coverage and pay yourself a salary and a pretty good salary. And so this is always, when I point to oftentimes the differences between buying a business versus starting a business, this is one of the reasons I really love buying existing businesses, because you know what you're walking into. You're walking into immediate cash flows. And if you're a good fit for that business, hopefully you're going to take it to the next level, and these numbers are going to look even better.
Yeah, you kind of get lost sometimes in these coverage ratios and the analysis, but the reality is that these are the approach to that has proven successful in the lending world. But you're absolutely right. If your debt service is 394,000 and your cash flow is 750, you've got a pretty nice little cushion there, even though you may be at a 1.5 or a 1.4 or 1.6 worth of coverage.
Yeah, right. All right, so Doug, let's move over to the other side of the ledger. And now with the CARES Act, we get some tremendous benefits and real incentives for buyers to get a deal done between now and the end of September.
Yes, absolutely. So the big thing here is that the SBA fee is waived. So any deal that is approved and booked and fully dispersed by the end of September, the SBA fee will be completely waived. So that $66,000 that otherwise you would have as part of your project cost is no longer there. So in our example here, we've got their $3 million purchase price. The only other component of the project cost is the bank's closing costs, which we're estimating at $10,000. So now you got a project cost of $3,010,000 compared to the previous version of $3,076,000. that drops down your required equity injection. And these numbers, it doesn't look that dramatic, but your equity injection here is 301,000, whereas before it was 307 roughly. The seller note is still the same 300,000. And so your bank loan now, because you no longer have those SBA fee in there, is 2,409,000 compared to 2,468,000.
Which doesn't seem like a lot, but when we get to the bottom here and we talk about a loan that's amortizing over 10 years, it's a significant difference. So we'll go through the rest of this, but you'll see, folks, how this really, that SBA fee being waived and one other big incentive make a big difference.
Yeah, I would agree with you. So if you follow down in the structure here, we've got that $2,409,000 loan, 10-year term, 5.5% interest. Your monthly payment is $26,144, whereas in the prior version, it was $26,789. So about 1,700? What is the difference there?
Yeah, on an annual basis, it's about $8,000 difference.
Yeah, on an annual basis, 7,700 and change. Yeah. So your total debt on the annual basis, 313,728. Seller note stays the same, and we kept that in at 5% at 5 years. Same with the line of credit, $100,000, 5.5%. So you get $5,500 of interest. So now here, your total debt service, because of the lower bank payments, is $387,164 compared to the prior $394,900. So the difference there, $7,736. So then it's a 10-year loan, and so if you multiply that by 10 years, 120 months, your savings is going to be $77,360. So that's a nice thing, and that alone is a good thing. The other aspect that I'm not sure we touched on yet today is that one of the other benefits of the CARES Act is that the SBA actually pays the first 3 months of principal and interest to the bank on your behalf for every SBA loan that's booked and fully dispersed before the end of September. And those 3 payments are capped at $9,000. So in this case, your payments are more than $9,000. So they will pay $9,000 a month or $27,000 in the first 3 months. So your savings with the CARES Act benefits are that $27,000 plus the $77,000. So you're saving over $104,000 due to the benefits if you book an SBA deal before September.
That's a big deal. Over the life of a loan at $3 million. So some tremendous benefits here for people who are looking to buy a business today and can get it done before the end of September. And you still have time to be well within that window, but the clock is ticking. And as we get into late May and early June, people are going to really need to have to hustle in order to meet those requirements, because you throw in diligence and closing time and the bank time, and you got to figure you need at least 90, sometimes 120 days to close a deal. So back yourself up from the end of September and figure out when you need to have a deal under contract. And the 90 to 120 days assumes everything goes pretty well. Maybe a few hiccups here and there, but everything goes pretty well. So you may need even more time than that if you've got a deal that's that is going to have some stumbling blocks or speed bumps along the way.
Yes, absolutely.
Well, Doug, this has been tremendous. As I mentioned to everybody, this spreadsheet side-by-side comparison is going to be available on our website at K2 Advisor, K, the number 2, ADVISER. Go to the resources tab and we'll have it there for you. Be able to download it. You can see it side by side. Doug, if people are needing to, understand more about SBA loans or, help you, help them get a loan. And I know you work with about 18 banks, so you've got a bank for just about every situation. And you can even be competitive in the sense that you could shop a deal to a couple of different banks to see where the best deal is for each client. How could folks get in touch with you?
So my email address is dadams@emersoncapitalcorp.com. Website is www.emersoncapitalcorp.com. My direct phone number is 773-368-9611. And if you are interested in talking about whether or not you qualify as a buyer, I would be happy to go through that with you. And the other thing about it is looking at the cash flow. We talk about the assumption of $750 worth of cash flow, 750,000, but what makes up that cash flow? And we need to look at those kinds of things, as you and I do all the time. Are these add backs legitimate? Are they verifiable? And those kinds of things. So we can help you through that process, and it's been working pretty well for us.
The road to getting a deal done is hard, and you need experts, and you are an expert. And I highly recommend people contact you if they're going down this path and need lending. Doug, as always, great content. Always appreciate you being here. And thanks so much.
Thank you for having me, Dominic.
I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.